Good afternoon. On behalf of myself and my team, I'd like to extend a warm welcome to you all and thank you for taking the time to come out to our 2018 investment conference at this splendid location. Just to say, we have no planned fire alarms, so if anything does sound, we're to head out through this exit and into the front car park onto the lawn in an orderly manner. If I could ask you to save the questions to the end, and then we'll have a question and answer session to make sure that everybody gets any questions fully answered between myself and Naomi. Despite all our modern academic theories of risk and risk management, most ordinary people with an interest in markets and investments remain permanently bewildered. One large reason is that the idea of uncertainty, whether in economic results or securities prices, is used interchangeably with risk. Very simply, risk, that is the fear that something goes wrong, can be simply avoided, embraced as an opportunity, or insured against. Uncertainty, however, is a permanent part of life. We're surrounded by inescapable uncertainty. What we seek is knowledge of the world around us and what the future holds for us. It enables us to make better decisions. A huge volume of information is coming to us from various media sources: television, radio, the internet, tweets, telephones. It leads to much excitement, pumping up the case for buying a market or a particular stock, or forecasting the end of a market with a collapse. In many cases, what we read or hear tells us nothing of real value that sheds greater light on a subject. It's basically endless chatter, or what we would call noise. Obtaining independent critical commentary is not straightforward. Too much of what is printed as expert opinion or accepted economic theory is often clouded by vested interest or political ideology. The poor availability of unbiased knowledge is evident in respect of our monetary system. Few people really understand how money is created or realise how money is controlled, and it's an incredibly complicated subject. A noted economist, John Kenneth Galbraith, said, "The study of money above all fields in economics is one in which complexity is used to disguise truth or to evade truth, not to reveal it. When your salary or your career depend upon supporting the official line or promoting a particular view of the world, there are very few people who are willing or able to speak out." George Orwell said, "During times of universal deceit, telling the truth becomes a revolutionary act." And on this quote, I'm delighted to introduce and welcome back our guest speaker, Naomi Prinz. Naomi is uniquely qualified to provide an independent and highly informed commentary on the monetary system and the events that are driving the global economy. Naomi has extensive experience of investment banking. Before becoming a journalist, she was managing director at Goldman Sachs on Wall Street. She ran the International Analytics Group as Senior Managing Director at Bear Stearns in London, and she worked as a strategist at Lehman Brothers and analyst at the Chase Manhattan Bank. Naomi has appeared on numerous TV programs, international for the BBC, RTTV, and nationally for CNN, CNBC, and Fox. Her writing has been featured in the New York Times, Forbes, Fortune, The Guardian, and the New York Daily News. She's spoken at the Federal Reserve, IMF, World Bank Annual Global Central Bank Conference and many other major venues. She was a member of Senator Bernie Sanders' Federal Reserve Advisory Council. In 2012, she released her book, All the President's Bankers, which explored and examined the special relationship and clandestine relationships between every US president since 1914 and the leading US bankers of the day. She's currently on tour promoting her new book, Collusion: How Central Bankers Rigged the World. Yesterday we listened to her talk in the Houses of Parliament in a similar discussion at the LSE in the evening. Ladies and gentlemen, please give a warm welcome to Naomi Prinz.
Thank you for that lovely introduction. Steve, I also thank you all for coming. It's really nice to be back, and I just want to say something about Steve and about his team, because I do talk to a lot of people around the world in different venues, and I have to say that the care, the detail that he and his team provide, not just events, but to their clients, to their customers, is really so superior to so much of what's out there. And I just want to thank you for continuing to have this relationship, and thank you all again for coming. One of the quotes that Steve put up from John Kenneth Galbraith about money and the complexity of money is interesting, simply because I was actually on that Federal Reserve Advisory Council for Senator Bernie Sanders a few years after the financial crisis happened, with his son, who's a professor in Texas. So it's interesting that, you know, the things that happen historically, the people that are involved and quoted throughout the world because of the observations that they have made. And John Kenneth Galbraith wrote a very substantive book about the 1929 stock market crash that happened in the United States and subsequently set off a Great Depression throughout the world, and has been a very important economist and academic throughout the years, as is his son. So that's just an anecdote that ties our thinking together. So I wanted to share that with you. One of the events that I had spoken at that led me to this particular book, to Collusion, and to really analyzing what has happened in the world from the standpoint of central banks, monetary policy, the markets, the economies throughout the world since the financial crisis of 2008, is a talk that I gave at the Fed in 2015, so a few years ago. It was right after my other book had come out, All the President's Bankers, and I had looked in that book at the historical relationships between the presidents of the United States and the major bankers throughout the different decades, and how those relationships really formed U.S. policy, domestically and from a foreign policy perspective throughout the years. Those were the relationships that funded world wars. Those were the relationships that potentially funded infrastructure in the United States. Those were the relationships that worked to provide money to the banking system when it needed that money. And those relationships that sort of continue to this day. So for example, one of the bankers in the currently, the most important banker, I would say, right now in the United States is a man named Jamie Dimon. He runs J.P. Morgan Chase. I used to work at Chase back in the day. It was the first place I started working. I was a programmer. I looked at the numbers as the market was becoming more complex, as what banks were doing were becoming increasingly complex, as risk could be and was introduced into the everyday interactions between regular banks and individuals who had accounts with those banks, and ultimately throughout markets and throughout the world. And he is currently a very important banker because he runs that bank. It is the largest bank in the United States. He was also at the center of the financial crisis of 2008. So when banks were facing the abyss of their own activities, when the assets, the toxic assets they had created, were imploding the financial system and potentially going to hurt economies and produce another Great Depression throughout the world, he was on a directorship position at the New York Federal Reserve. The New York Federal Reserve is one of 12 reserve banks that make up the U.S. Federal Reserve. That was established in 1913. It was established by bankers including J.P. Morgan. It's now on the name of J.P. Morgan Chase, the largest bank in the United States. J.P. Morgan decided that there needed to be a central bank that could save the other banks or produce money for them in the event of an emergency. He had undergone an emergency in 1907. So in 1907, there was a big panic in New York. in the United States. And he was asked by the President of the United States at that time, Teddy Roosevelt, to take some money from the Treasury Department, figure out how to use it to beat back the panic or the crisis that had happened, and then kind of save the markets. And he did that. He took money from the Treasury Department, he gave it to his friends, he gave it to the bankers he liked, the bankers who were involved in his family and with whom he shared stock and meetings and library cigars and all that sort of thing. And he decided that might not be enough next time. And so he was one of the people that sponsored a collection of individuals who went in 1910, 3 years after that crisis, first to London and to Paris to determine how central banks worked in Europe and to come back with reports to the Senate, to the government in the United States and say, look, this is how they've been structured. You know, there's been wars, there's been situations. They've been structured to effectively provide money in the event of an emergency as well to the banks in the United Kingdom, to the banks in France, etc. So they came back with a report and said, this is what we want to do. That's how the Federal Reserve in the United States was created, but it was created in a slightly different manner than it had been created here. It was created in a manner that indicated it was independent from the U.S. government, so that the people of the United States who had just undergone this panic, who had seen Wall Street as being completely criminal and affecting their own economies, their own lives, it basically said, you know what, we're not going to do that same thing. We're not going to connect to the government. We're going to have an independent bank. It's going to be a reserve system, and it's going to have all these little banks throughout the United States, 12 of them, and each of them are going to regulate, provide rules, analyze risk for the banks in their own area, in their own community. So in San Francisco, in Dallas, in Kansas City, in St. Louis, in different cities throughout the United States, there were different pieces of the Federal Reserve System. And then there was one in Washington, there was one in New York. The one in New York, of course, was the one closest to J.P. Morgan. He had died by the time the Federal Reserve System was created in 1913, but it was closest to most of the money and most of the influence in the United States, from respect of the bankers to the politicians to the government in Washington, D.C. And as a result, the New York Fed wound up having the most power over how the Fed ultimately operated. And the main Fed in Washington, D.C. had the proximity, was right next to basically the White House, right next to the core of political power in the United States. And these two Feds, the main Fed, the Federal Reserve and the New York Fed, are really what got together and decided how money would be created in the wake of the financial crisis, who it would go to help, and ostensibly created a policy that became global, that was exported back to the UK and back to Europe and to Japan and throughout the world. And one of the people that was involved in that policy was Jamie Dimon, sitting there at the New York Fed, who said, look, our banks are in trouble. This was the fall of 2008. Lehman Brothers had imploded. One of my old firms, Bear Stearns, one of my other old firms, had imploded in March, a number of months earlier. And he basically said, look, we need a policy. We need something to be done that will plug the holes of these banks, that will help us get through this crisis. And he had kind of this non-public role in shaping what the Federal Reserve would do, what it would do for the New York banks, and ultimately what it would do for the world. He wasn't the only one. The other person that had a role in determining that was Hank Paulson. Henry Paulson was the CEO and chairman of Goldman Sachs when I worked there. He also made his way up to being the Treasury Secretary for the United States under George W. Bush. And when the crisis happened in 2008, he was the Treasury Secretary. He had a lot of friends still on Wall Street, a lot of friends still at Goldman Sachs. He also wanted to help them, right? So those are two people. The third person is Timothy Geithner. Timothy Geithner, who became the Secretary of the Treasury after Hank Paulson left and when Barack Obama became the President of the United States, was the president of the New York Fed, where Jamie Dimon was a director. So now he has, in the fall of 2008, a reason to help people like Jamie Dimon on all of the banks on Wall Street, because the New York Fed is located literally next to where the headquarters for Chase was and located near the power banks of Wall Street. So he's involved in this. Timothy Geithner is involved in this. Hank Paulson is involved in this. President's not so much. The head of the Fed at the time was a man named Ben Bernanke. Ben Bernanke was, in his opinion, a student of the Great Depression. The exact thing that John Galbraith wrote a fantastic book about and ultimately wound up becoming he's a world-class economist. Ben Bernanke saw the Great Depression as differently than other people saw it. He saw it as something that could be avoided by providing money to banks. And his job happened to be in a position where he could provide money to banks. So what he created was something called zero interest rate policy, which basically meant that he put down the rates, his Fed, put down rates to 0%. The idea being that all these banks that were in trouble would be able to go to the Fed, their parent, and say, look, we crashed the car, we need some money, we need to drive somewhere else, help. And Ben Bernanke said, okay, fine, we'll sort you out. But he didn't just sort out the United States banks with 0% money, with basically free money. You don't have, there's 0%, it's kind of like a forever loan. What he also did was say, I'll do something else. You still have some assets on your books based on some of the things that have gone wrong, that you've done, but he didn't say it like that. You have mortgages on your books. You have complex, back to Galbraith, securities on your books. We will take them from you. We will give you money. We will fabricate money. We'll basically electronically provide it into your accounts. I mean, imagine you go to your ATM machines, you have 100 pounds, and all of a sudden it's like 10,000 pounds. That's awesome. And we will buy those mortgages from you so that A, you will get money, and B, you will be able to value all of the other stuff that's not really valuable on your books, all the other mortgage assets, all the other complex securities you have, higher than they should be valued. Why? We're paying top dollar for assets that are not worth top dollar, assets that are still imbued with risk. But we're going to do that because we're going to help you out. And then, because we've been this buyer, you can go in and you can value your other assets higher. That makes you look really healthy. We're basically buying your junk for nothing, just to value your junk more. And it wasn't just for JP Morgan Chase, it was for the major banks in Wall Street. Over the 10 years since then, they've all copped settlements. They've paid over $100 billion in fines to the Department of Justice in the US, to various regulators in the US for crimes they committed into the financial crisis, and even since the financial crisis, that the Fed, the parent, who gave them money in their hour of need, completely ignored. They collected some of the fine money, but they ignored the problems in the banking system, the risks that the banks were creating, and all they did was basically throw money at the problem. And then they got the world involved. So the Federal Reserve electronically conjured $4.5 trillion worth of money. This was supposed to be an emergency policy. There was a clause that JP Morgan's people put into the original language of the Federal Reserve Act in 1913 when it was created that's called an emergency lending clause. And it basically says, in the event of an emergency, you get to take liberties, I'm paraphrasing, but basically you can do what you want to protect the financial system to get through the emergency. So what the Fed did in 2008 was it took that really, really seriously. And it said, we have an emergency. But that emergency and the policy that the Fed underwent by conjuring $4.5 trillion of money to buy assets from the banks and buy government debt from the government, who also issued debt in order to save the system and supposedly help the economy directly. That $4.5 trillion became $21 trillion globally, because the Fed couldn't do it alone. It couldn't simply save the US banks, because the US banks were so intertwined with banks throughout the world, with banks in the United Kingdom, with banks in Europe, with banks in Japan, that if they just plugged the holes of the crime and the complex businesses that these banks had conducted in order to ultimately implode the economy potentially, it had to have help throughout the world. So the collusion that I talk about in the book is that help that the Fed required from the Bank of England, from the European Central Bank, from the Bank of Japan, in different ways, from the People's Bank of China, from the National Bank of Switzerland, and so forth, because what it required to make this help work, to basically fix all the cars that were crashing and be the parent to the world, was to have all the other central banks help. And that's how $21 trillion of money got created throughout the various central banks. The European Central Bank kicked in what is now about $5.5 trillion. The Bank of Japan kicked in another about $5.5 trillion. So they actually ultimately surpassed the emergency, supposedly just the emergency plan of the Federal Reserve, which has now gone on for 10 years, really long emergency, in the amount of money that they fabricated. The Bank of England has fabricated about $800 billion, 600 billion pounds at the moment, though it has not stopped. The European Central Bank has not stopped. The Bank of Japan has not stopped. Just early this week, the People's Bank of China fabricated $300 billion worth of money to go and buy Chinese companies. So this whole idea of fixing a problem by throwing money at it and not analyzing the risk that produced it and not reforming or changing the rules to ensure that that kind of risk doesn't happen again was completely thrown outside the window. One of the day jobs of the Fed and other central banks is to regulate the private banks in their area. That's kind of part of the point. The Fed did not even see the emergency coming that became the financial crisis of 2008, and they've absolutely not since then determined how to avoid a second crisis. All they've done is say, you crashed a car, here's some money for another car. We're not going to try to figure out how you can become a better driver. That's literally all they did. And they exported that. So now the other ramifications came from that. Because money, the cost of money for banks, was put down to 0% globally. In Europe, it's negative. In Japan, it's negative. Which basically means that central banks are paying banks to give them money. That's what a negative interest rate means for banks relative to the central bank in their area. It effectively means that they are getting money to take money. The Swiss, also negative interest rates. And so what that has done is it's created this incentive of banks and of corporations who are closest to the banks, so the largest corporations, to issue more and more debt. Because it's really cheap to borrow. If rates are at zero, and I believe they are staying at zero on average across the developed countries of the world for a long time, and I'll explain why, that's easy. You just keep borrowing money and you worry about restructuring all your problems or whether you're profiting or whether you're paying people or whether there's risk inherent in that exercise whenever, just way later. And that's the policy, quantitative easing, which is the other part of zero interest rate policy or negative interest rate policy, is quantitative easing. That's like a really wonky term. And it's really odd that you go around the world now, and even if someone doesn't really know what a central bank is or doesn't know exactly how they do it, it's a phrase people are actually familiar with. It's a silly phrase, and what it means is that if I've been able as a central bank to reduce rates to zero, because I can do that, but they need some help. Quantitative easing or conjuring money or producing liquidity for banks in order to buy mortgage bonds, buy government bonds back from them, buy corporate bonds, buy stocks. That's a means to keep that cost of money low. Money's so prevalent from these central banks going out to either the private enterprises that it doesn't mean anything. And that's quantitative easing. It's literally producing more money on top of having rates be zero. It makes money even cheaper. There's so much of it, it doesn't mean anything. The Bank of England, if you go to their website, defines quantitative easing as an emergency policy conducted to provide money supply into the financial system. They define it like that. The actual meaning of that is putting a lot of money into the system and hoping it will sort of correct itself in an emergency. Again, 10 years. Last week, the Bank of England decided not to raise rates. meaning not to increase the cost of money, not to make money more valuable, because it also reduced its forecast for growth in the United Kingdom. Why did it do that? Because 3 months before that, 90% of the analysts that follow this sort of thing in the mainstream had predicted that interest rates were going to rise. The Bank of England viewed all of the information in their purview about the economy here, about inflation, about growth, about predictions of growth, and their determination was that money could be a little bit more expensive, a little bit, 0.5%, still very, very next to nothing. And their determination was that growth wasn't even high enough 3 months after they predicted it would be in the real economy in order to enable them to raise rates by even a teeny tiny bit. The Federal Reserve had done the same thing the week earlier in the United States. The Federal Reserve had decided not to raise rates and make money a little bit more expensive, a little bit more valuable, a little bit more real as well. That's collusion, where the Bank of England, yes, it might be looking at growth in the UK, but it's also very connected in this whole central bank monetary policy system to, for example, the Federal Reserve. So if the Federal Reserve isn't making its money more expensive, for whatever reasons it's saying is the point of not doing that, well, the Bank of England's going to do the same thing. The fact is that growth also had an increase, and their forecasts for growth have decreased in the UK. But the underlying collaboration or collusion of central banks has them all sort of doing the same thing to cover each other and to basically protect each other's backs and somehow indicate that this 10-year emergency policy is actually working for real people. There are also a bunch of people in the streets of London demonstrating because their wages were not making them enough money to cover the cost or the increase of their costs in life. The data, historical data, shows that over 17 years, wages have effectively not kept up with the cost of living. And it will take until 2025, so another 7 years, if things don't go really, really wrong, for wages to get up to the cost of living that they had before the financial crisis, so in 2007. So what that means is that this policy of lavishing $21 trillion of fabricated money on the world, which has also created the ramification of additional debt being borrowed because money is so cheap, and the stock market's rising because all of that money has to go somewhere, and it can't get any return on bonds, it can't get any return in savings accounts because rates are close to zero, it goes into the stock market. So all of that artificial sort of cascade of money looks like it's going into places that are either increasing debt or increasing the value of shares in different stock markets. When the Bank of England did not raise rates last week, the FTSE 100 went up. So if you think about this logically and just how distorted it all is now, theoretically, the share prices of companies should go up when they are growing, when they're healthy companies, when the economy around them is doing okay. But we're so twisted in this collusion era, post the financial crisis and what central banks have done together to render money so cheap and conjure it into the financial system, that the market did the exact opposite. The market was like, great, you're not raising the cost of money because growth is bad and because wages haven't increased. That's awesome. And they basically, that was the reason that markets rose. They rose today. I mean, the US market was down today. FTSE 100 is still up. And now it's up because the expectation is, despite what all the analysts thought in the beginning of the year about the Bank of England tightening rates, raising the cost of money, everything that Mark Carney, who runs the Bank of England, said since they didn't raise rates has indicated they're not going to anytime soon. That means the cost of money remains cheap. That means the policy of the Bank of England is to continue to manufacture cheap money for the markets, and that's why the markets are going up. And that's a phenomenon that's going up throughout the world. So there's two results that happen from this policy. One is that the central banks can continue to create money and keep the cost of money at zero forever. And what that means is it's kind of like you're in a holding pattern. It's like, sort of hovering around Heathrow while you're waiting to land, and you sort of keep seeing the same scenery at the bottom, and you want to get to your next place or just out of the plane. And that's what they're doing. They're basically keeping this quantitative easing policy going and going and going, because the fear is that what happens when it stops? Well, either all of this money that has lifted the system up seeps out from all the places that it's gone to, and you crash. Or maybe you can figure out how to lower the plane in such a way that you don't crash. The reason they're not moving too much, central banks aren't moving too much right now, is because they really fear that crash. And there are reasons to fear that crash. Because if companies and governments have borrowed so much money so cheaply over the years from central banks that don't have to be accountable to the public or to real growth or to anything, because these leaders pretty much jet into their governorship positions around for a few years, push some dials around, electronically conjure some money, and then they're off. And they're giving speaking engagements for lots and lots of money in the private sector and so forth. They don't have accountability to the public. They don't have accountability to the governments. They don't have accountability to the economy. So they'll be out. They're afraid. None of them want that crash to happen on their time. And that sort of hovering, them not wanting the crash to happen on their time, is why the markets are still up. It's why the equities markets are still up. It's why the FTSE 100 is still up, because it's still relying on all this money that's been put into the system. And that's one of the things that central bankers really look at. And so you'll notice, and I talk about a lot of examples through the history of these last 10 years in my book, in different countries and different regions throughout the world, from Mexico to Brazil, Japan, China, throughout Europe, the UK, is that what the central banks really watch is not growth. What they really watch is the level of the stock market. They don't say this, but their actions speak much louder than their words, or lack thereof. In terms of the debt that's been created right now in the world, there's about 2.3 times the amount of debt to GDP. So more than twice as much debt in the world is supporting actual production or real economic activity in the world right now. And that figure has increased substantially since the financial crisis because of all the borrowing that's gone on the back of these cheap rates. If that starts to crack, if the companies and the countries that borrowed all this money over all this year so cheaply really can't repay it, or rates go up by even a little bit, which is why they're not, but if they do, as the Fed started to raise rates in the United States, then what happens is it becomes more expensive to repay that debt. It's like if you have a credit card at 0% interest for 18 months, which U.S. banks churn out quite a lot so that people will borrow and turn over and borrow and turn over, at some point you have a massive amount of debt, and if that rate goes up from 0% to anything, you have extra costs each month. And it's the same thing with corporations, and it's the same thing with governments. So the companies that took on the most debt in the last 10 years throughout the world are the ones that are in the most potential problem if that debt becomes more expensive, or if the profits that they make, the revenues that they bring in, simply don't cover the cost of servicing the debt that they borrow. Now, in a lot of markets, these companies have used that debt to buy their stock. And share buybacks, as we call that, are very prevalent. They're particularly prevalent in the U.S. markets by companies borrowing money to buy their own stock. They're prevalent in the Japanese markets because the central bank, the Bank of Japan, actually buys stock directly. The Swiss National Bank buys stock directly. So the combination of either companies borrowing money to buy their own stock or central banks buying it directly has also inflated the stock market and will continue to inflate the stock market again until repayment is too expensive. And that's when things start to implode. And what I talk about in the end of the book is the idea that there's only a couple ways out of this, and there's also things to watch from an allocation or an investment standpoint in the wake of what's still going on. I think to get out of it, you have to do that soft landing. And the only way to do that is to utilize some of the debt that's been created, or restructure it, or write some of it down so that it's not so massive if rates go up, and that rates can therefore start to go up. And we can start to get back into sort of a normal kind of monetary system where people actually do get paid to put money in a bank. Where your current accounts, your savings accounts, our deposits, they actually produce some sort of income. And government bonds, which used to be the safest form of investment, actually start to have more value because the return from them is much higher than close to 0% for shorter term bonds or 3% for longer dated bonds. That's when we start to have more comfort, less risk in the market. In terms of how that works out, from an investment standpoint, what you do now is, I'll go back to what I said before about actions speak louder than words. Central banks say a lot of things. And mostly, they say them to make themselves look good. My kid's never going to crash their car again. But the reality is they haven't fixed a lot of the systemic problems in the financial system. So all they can do is hope that on their watch, that crash won't happen again. Which is why you have to look at their actions instead of their words. And their actions indicate they're still afraid of another crash. And that's why markets throughout the world tend to still be overvalued and will continue to be overvalued. And that's why some countries have done different things with the money they've created or fabricated. China, for example, has used money it's fabricated, the People's Bank of China, to invest in real development and real infrastructure in China and throughout the region. So companies that are associated with that actually have some real value. They're actually doing activities. The United States has not really done that. Most of the money, in fact, 99% of the profits of the same banks that created the financial crisis that we're still dealing with, 99% of their profits last year went into buying back their shares. 99%. That will be about all of it. So that's what they're doing with that money, and that's why this cheap policy and quantitative easing and the central bank collusion enables that to continue to happen. So as long as that's the policy, as long as those are the actions of central banks, it's going to continue to give a bid to some markets. And the companies that actually make up those markets that borrow the least amount to either buy their own stock or just to operate or just because it was available cheaply are the ones that are ultimately going to do the best, and ultimately the ones that if there is a financial crisis or a crash will have enough solvency, will have enough reserve, will have enough money in their own banks to be able to ride that out. So there's ways to look at this policy in terms of how you look at asset allocation and preserving capital and also reducing the potential risk that's inherent to this crazy emergency policy that's been going on now for 10 years. And I know that that's one of the things that Steve does here very, very well, is not try to front run the market, not try to find the next cool thing that's going to go up by 1,000,000% tomorrow, but to basically look at preserving capital and growing it in a way that's cognizant of what's happening in the world, whether it's geopolitical risks that can come in or whether it's central bank risk that's inherent all the time right now, and how to manage portfolios accordingly. So with that, I'm going to turn it back to you, and thank you for listening and for your time and for being here this afternoon.
Thank you, Naomi. That was fascinating and very insightful. Have we got a razor to... I think there was a saying, somebody said, when the music is playing, you have to dance. Was it Lloyd? It was one of the...
It was the head of Citigroup.
It was Citigroup, yeah. And the music is still playing at the moment. It's been extended. And what I'm going to say is that I don't see a major crash just yet. I think it's going to be delayed for some time. Now, what Naomi was saying there, I'd like to draw out two key points, two key implications for a portfolio allocation. The first is central banks are not tapering. They're not collectively tapering. The Fed, the ECB, the Bank of Japan, they're going to carry on with asset purchasing. In other words, they're not reducing their balance sheets. As the government bonds they hold mature, they're going to continue to reinvest these with new bond purchases. In addition, inflation is still too low in Europe and in Japan, and this provides the excuses that the central banks need to continue quantitative easing, as Naomi's pointed out. Second, the pace of rate rises is going to be much, much slower than the market expects it to be. The Fed's stall on the rate rises shows that they're focusing more on growth data and less on the inflation data. And effectively, as Naomi pointed out, first quarter growth has raised concerns of a slowing economy, so that's another reason that rates are not going to be going up. And they're reluctant to do this because basically they don't want to upset markets and growth. So what we have are two further implications. We think that developed markets, in terms of stock markets, will continue to have upside. Because monetary policy is so supportive for stock markets. In addition, we've actually seen that the S&P 500 earnings in the first quarter of this year have actually increased by over 5% to nearly $34 per share, which is the largest increase since 2004. So there are some positive messages coming through. Consequently, although valuations are very high on the traditional measurement of PE ratio, they're looking less stretched than they were a year ago when we did our conference in March. But we do think that there's better value outside the US in terms of equity markets, and particularly in the UK. The UK is probably the most unloved stock market in the developed world right now for international investors. Brexit negotiations are one of the reasons for investor aversion. But on the basis of a pragmatic solution being found, there's a very good possibility that UK companies offer better potential upside than any other market in the world at the moment. The second point is that the Fed is more concerned, as we've heard, with not impeding growth than with inflation control. Now, with increased tensions in the Middle East, it's all underpinning higher oil prices and feeding through to higher prices in commodities and food. As the Fed concentrates on the growth data to determine rate rises, it's becoming more relaxed on the inflation data. Consequently, the Fed and the Bank of England are both quite likely to fall further behind the curve on inflation control. Now, don't forget, the dual mandate is inflation control and price stability, but the 2%, which they've had as a target for many, many years, is becoming almost irrelevant. So whilst inflation is nowhere near the levels seen in the 30 years prior to the financial crisis of 2008, we can probably expect inflation to continue to creep along in the 2 to 3% range. The biggest rise to stock markets are rising rates, hence the concerns with long-term yields. Now, this is a graph of US 10-year treasuries, and it shows the yield. It goes all the way back to 1928 over on the left-hand side, and it makes a peak in 1980 when yields on 10-year treasuries and in the UK were circa 14-15%, and they went up as Paul Volcker at the Fed tried to combat inflation. And then what they've been doing ever since, they've been coming down. They've been coming down in this trend. Inflation's been coming down, yields have been coming down as we've imported deflation, lower costs from abroad. And then after 2008, they started to really go down. That trend has really been quite a low inflationary, low yield trend. But what's happened the last few years, it's started to re-establish a slightly higher trend upwards. Now, we're not suggesting it's going to be going up there, but certainly it's broken a 3% yield. Consequently, markets are anticipating longer end of the yield curve to remain higher. It won't be dropping in any big way again. So in respect of portfolio positioning, we think three things. First, keep an exposure to stock markets, but overweight UK equities as opposed to any other market, and look at companies or sectors that have got good yield and low PE valuations. Yields in the UK are very, very attractive with many companies, 4%, 4.5%, and PE valuations, which is the price of the share against the earnings, are also very attractive. Some are lower than 10. On a long-term average, they're typically 15. In the US, they're middle 20s. The UK right now, you can pick up some very good companies with yields of less than 11 or 10. We also think that you should look at index-linked bonds, and that's because we see a steady, continuing inflationary creep. So better to hold longer-dated UK inflation linkers than long-dated Treasury bonds, where you'll see the value of the bond reduce as the yield goes up. So consequently, your third bit of advice would be to rotate from long-dated fixed income to short-dated fixed income. And these are the three areas that we would suggest would be relevant now for the short to medium term. Further out, monetary tightening will bring about the end of the current cycle. Business cycles are a way of life. Gordon Brown learnt this the hard way sometime after he proclaimed the end of the business cycle and the end of boom and bust. The one common denominator that signals the end of every business cycle is tighter monetary policy. When credit becomes more difficult to obtain and rates go up too quickly, the cycle turns and recession kicks in. And as Naomi's very clearly explained, central banks are in a very precarious position. Their objective is to remove some financial support that they're providing for the economy and the stock markets and normalise rates, but it's a totally delicate balance between achieving these objectives and the risk of over-tightening, creating market instability and resulting economic slowdown. So this current cycle is proving to be a very, very long one. I think it's the second long one now on record, but it could go on a lot longer. It's that airplane, as Naomi explained, is having problems coming down. It could be there for a long time. And it's going to include regular episodes of stock market volatility. Now, we've talked about geopolitics, we've talked about monetary policy, we've talked about the economy, we've talked about stock markets, and this key thing of uncertainty. The best way to deal with uncertainty is to accumulate wealth. Wealth gives us peace of mind about the future. But if wealth helps us in coping with uncertainty, it's also subject to uncertainty itself. And our current monetary system, as you've heard this evening, adds considerably to this uncertainty. It's for a good reason that economics is often called the dismal science. When inspecting the vaults at the Bank of England in 2010, just after the financial crisis, Her Majesty the Queen turned round to the Governor, Mervyn King, and said, "Why didn't anybody see it coming?" Our savings are subject to a myriad of uncertainties: inflation, taxation, regulation, and controlled by events and parties outside our control or influence. In addition to these external factors, private capital is also subject to bad decisions, misplaced emotion, improvidence, and financial charlatanism. Once wealth is accumulated, it's not a mundane task to preserve it over a long period of time. Accumulating wealth depends more on avoiding large losses than making enormous gains. And this is absolutely crucial, because a 50% fall in the value of your portfolio requires a 100% increase to get it back. So we believe that successful strategy for wealth preservation should include the following. It should be sufficiently diversified in assets that are genuinely non-correlating. It should include a portfolio of businesses that are truly creating economic value, i.e. transforming resources into goods and services that people genuinely need. It should include real assets, property, land. As many people know here, we're very keen on forestry. and you should maintain sufficient liquid asset reserves of good quality for uncertainties and unexpected future events. At 2H Wealthcare, David, Lev and myself discuss and consider changes in the economic outlook, we review investments, we consider new ideas and we share market information. We follow independent commentators such as Nomi, and using this strategy we then apply this to the advice that we give to our clients. But we recognise that it's our clients that create their wealth through a steady accumulation of a lifetime of employment or a profession, or as a result of a successful entrepreneurial activity. We treat our clients' wealth with respect, with integrity of purpose, and with care in application. I have no hesitation in saying that we are cautious with what we do. Sometimes we may be too cautious. Finally, we never believe the much-used claim to justify the reason for this stock or this market being abnormally high. It's different this time, because history tells us it's seldom been true. Now I'd like to invite Nomi back onto the stage, and we're very happy to take questions. Okay. Yes, Till.
I'd like to ask the question as to why is it that we're not seeing incredible inflation? There used to be a time when pumping money into the economy meant would lead to inflation, and terrific inflation, a la Germany in the 1930s. Why aren't we seeing that?
That's an excellent question, and what we're seeing is inflation in financial assets. So what's happened is, if this money had gone to its stated purpose, which was to help the real economy through the private banks, lend it to smaller businesses, medium-sized businesses, real productivity, real infrastructure development, we would see more inflation. But because it's gone into more financial assets, into the stocks, into bonds, into certain home prices at the top level, those things have inflated substantially. And so we have had inflation, but just not classical inflation. So the measurements of this arbitrary 2% that central banks ostensibly operate under, and the idea is they create money, it grows the economy, it inflates prices, and they balance, which is sort of the classical idea, has kind of gone out the window. First, because the money hasn't gone into the real economy, so it hasn't really elevated prices to the extent that it has historically. And second, because it's just been so much not doing that. And that so much is why the stock markets are so high, and why share prices are being bought back by companies rather than using that money at those cheap levels to which they have access to actually grow them, to pay people, to hire people, to build new plants, or whatever it might be in that particular area. So it's how we see inflation classically versus today, which is the issue. And central banks are looking at classical measurements, or not, as the case may be. And inflation has gone into more speculative financial assets and not into the real world, because that's not where the money went.
Thank you.
Yes, Roger.
Of course, the other effect of the increase in asset values, which you just referred to, is an enormous increase in inequality in the developed world, which surely must be counted as one of the geopolitical risks that Steve was talking about. But there doesn't seem to be any recognition by the central banks of the potential dangers of inequality. Although Davos was discussing it, it was all in very abstract terms rather than actually saying, well, we've got to do something about it. So do you think there is actually any significant chance that governments and the central banks, who are probably, in your terms, maybe colluding with the wealthiest in the population, do you think there's any chance at all that they will reverse this policy and reduce the degree of inequality in our systems?
What's interesting about that question is that the Federal Reserve itself, every 3 years, produces an inequality report. And so the last one they produced was actually in 2016, so they're due another one next year. But in the last, their own inequality report, and now there's been several since the financial crisis began and since they've used the method they've used to ostensibly help the economy, they have shown themselves that inequality has increased, that the amount of wealth that has been created by their own policy has gone to the top echelons of society. That increases inequality within a country. So the number's similar here, but for example, in the United States, 10% of Americans own 84% of the stock market. So even the participation in the financial speculative asset bubbles that have been created is limited, and that increases inequality. The IMF, actually that same meeting I went to at the Fed was also a 3-day conference that they have, and they discuss whatever the topic is at the time. That topic was, why isn't Wall Street helping Main Street? But Christine Lagarde, the head of the IMF, addressed a luncheon the next day. And one of the things she said at the time was that emerging market countries were experiencing the possibility of much more risk as a result of these policies, and that their inequality was increasing as a result, which is what the IMF studies are beginning to show. The Bank of International Settlements, which is the central bank of the central banks, which has teams of economists and puts out lots of reports, has indicated inequality is increasing. So you would think that when the actual central bankers who created the policy under which inequality has increased get together, they would actually try to come up with solutions to this. The thing is, the only solution to this is really to dial back the program that accelerated the gap in equality. And they don't want to do that for all of the reasons that we were talking about right now. So as a result, there has not been, beyond warnings from some of these major institutions in the monetary policy arena, actual recommendations to do anything. The only recommendations have been sort of to not raise rates that quickly so as not to exacerbate the debt that has basically accompanied that increase in inequality throughout these years. That's about as far as they go. They also, well, whole separate other thing, and they get together at these, sort of international luxurious locales and talk about these topics of inequality. I mean, what they eat alone could, feed entire communities and villages. So they really don't talk about it in a way that I think is result-oriented. I think they should. I mean, certainly there are us who are trying to get that to happen. They know it exists. They know it's increased. I'd like to say, yeah, they're going to talk about it and actually do something about it, but the reality is that will mean dialing back what they've just done, and they're afraid to do that.
The inequality is an absolute huge problem, and I think we're seeing the outcome in the rise of the populist movement and the discontent with the financial and political elite, as it's seen. But Roderick's absolutely correct. This inequality is absolutely huge. There's a measurement called the Gini coefficient, and it's recently been remeasured, and it's showing that the inequality between the haves and the have-nots is back to where it was at the turn of the 20th century. So it's gone back over 100 years. And if you look at the wages, the wage differences between the average worker and the CEO of public companies, it's increased over the last 30 to 40 years from 30 times the higher CEO getting against the average to 180 times. And when you see this level of inequality, it's going to cause a major, major problem in our society, and it is not being addressed. We were at a meet, I was listening to Naomi talk yesterday in the House of Parliament, and it's unbelievable how the politicians are not really grasping what's going on. I came away quite shocked and depressed, really. Not only do they not understand it, but they don't seem to have anything that is remotely an answer. They can't understand the vested interests that have taken over the financial system and financialised the economy. It's quite depressing.
And actually, the CO to pay in the United States is 457 times. So right now, from way lower. And actually, that's something to look at just in general. I mean, does a company that's so in itself unequal from the standpoint of what people that work there make versus what the CEOs make, I mean, is that ultimately a viable company? Anyway, they're taking out a whole lot from the top.
Ken?
You mentioned the ECB and its program of quantitative easing several times, but you didn't actually mention the euro or the eurozone. Now, we know that there have been strains and stresses for the last number of years, and people have confidently predicted the demise of the eurozone. What do you think the present situation in Italy is doing towards this? Because I see this as a flashpoint. We have two parties, both extremes, one on the extreme left, crypto-Marxists following Thomas Piketty, who's one of these French nutters that people seem to think is very clever, and the Lega, which was originally the Lega Nord, which is a very xenophobic right-wing party, yet they are talking about forming the government, all sorts of policies which go entirely counter to everything that the ECB and the rest of the Eurozone, at least the northern members of the Eurozone, are for. What do you think about that situation?
So I worked in London during the the creation of the euro. So basically, I worked in London through the 90s as a lot of the debates over to what extent the euro or having the EU from a monetary perspective, from a currency perspective, would hurt or harm or help different countries throughout the eurozone. And as expected, when the EU was created, when the euro was created, the initial benefit was to help some of the sort of weaker countries, but over time there was a sort of reversion to the stronger countries getting stronger and the weaker countries getting weaker. Now, I mentioned the ECB, and that's because in this context, the ECB has exacerbated that economic condition because of their monetary policy, and that has had the effect of making voters, and therefore the parties they attach themselves to, much more disillusioned with the entire process, as they are in any country. But in the EU, you have the sort of southern versus the core countries in general having different economic strengths. Germany has done very well in the wake of the financial crisis. They've done very well in terms of their economy growing. They've also had, even though they criticize it, Bundesbank is continually criticizing the ECB's policy of cheap money, but even so, they've actually benefited from it. You know, the only reason Deutsche Bank is still standing is because of ECB policy and the availability of cheap money into some of the major private banks in Europe. But what the ECB did is it also made other choices. In the beginning of the financial crisis, it chose to not work on restructuring the debt of Greece and instead posing austerity programs and putting in a bailout effectively of investors in Greece. And that was one of the things that weakened that country. In Italy, in Spain, in Portugal, and some of those countries, the ECB's made a choice over these years as to which banks and which countries it's helped with its policies. If you go on their website, and they're actually the most transparent in terms of where they put their money of all the central banks, ironically, they actually have a list that they publish on a regular basis as to which companies and which government bonds and by how many in each country they are going to buy with the money they are fabricating through quantitative easing. And the list is primarily the stronger countries in Europe. So they've created a situation where they've talked about inequality, that they basically increase the inequality economically by simply choosing to fabricate money and putting it in one place versus another place. That's had the effect in places like Italy of really creating additional economic anxiety. I mean here, as well in Brexit in the United States with what's going on in terms of how voters choose to basically go away from whoever's in power, whoever's in office. Whether you are left or right, whether the government power is left or right, the impetus when economic uncertainty hits is to go away from what you have. And that allows sort of fringe sides of the government or a government to attract voters because they're just anything different. And I think what's happening in Italy, and sort of this collaboration between the far left and the far right, and the language that they're using to attract voters, is not dissimilar to what's happened throughout the world as a result of the last 10 years. In Europe, there's the additional factor of that inherent difference being apparent before this monetary policy the last 10 years, going into the creation of the euro and the Eurozone and the EU. So that changes the dynamics. But the result has been the same. People are dissatisfied with what, they point to their governments, what they've done in the wake of the last 10 years. It so happens the central banks have had a big role in that behind the scenes.
I think there's... Sorry, Chris, yeah. I think there's a similarity with what's possibly happening in Italy with what happened in Greece. There was widespread discontent with government, very discontent with the EU, and it led to the election of the Tsipras government, who had a mandate to fight the bailout program. And ultimately, it went very badly wrong for the Tsipras government because the economic minister at the time was Yanis Varoufakis, who basically said, the debt's too big. We're never going to pay this debt back. You've got to give us new terms. You've got to write the debt down. And the EU wouldn't touch a debt reduction program. And when the crunch came to the crunch, and Varoufakis, as Minister of Finance, was saying to Alexis Tsipras, the Prime Minister, we have to pull out now. We've done everything we can to remain in the EU. We've got to come out, set up our own currency, start again. They didn't do it. They backed down, and in went the bailout program. All the state assets were sold off. Everything was effectively, Varoufakis said, you're putting us in debtor's prison for 2 generations. We're never going to get out. Now, they're talking at the moment that it's improving, but ultimately, they're not going to get out of debtor's prison. And what will happen is that if the Italian vote, and they continue this movement with anti-establishment vote, it will come down to the EU and driving the problem, or trying to fix the problem with a refusal of debt bailout. And it's a question of who will blink first.
The irony is that Mario Draghi, who runs the ECB, was running the Bank of Italy before he became head of the ECB, when Italy was having another sort of wrinkle of the problems it's having right now. And he's now in a position where he could technically help. And again, the choices are being made not to.
Chris?
Can I ask a question coming back, if I may, to the international situation, which you very interestingly remarked on. When we look at the financial crises that have occurred since World War II, I think the first one was 73-4. I was in the stock market at the time, and I know exactly what happened then. And the same things happened successively until the last one. And each time, there's been an easing of monetary policy, interest rates have come down, money's been made available, but losses have occurred. And certainly in that first one, where we had what was called a lifeboat, a discrete behind-the-scenes thing, all the stockholders lost out. And in all the other ones, there's been losses. Now it seems to me that the last time, 2008, when this happened, there weren't big losses like that. Okay, Bear Stearns went, but by and large, people were sheltered from it. And in this country, for instance, property prices didn't fall. Now, at the moment, if we were to have, let's assume we have a crisis, these policy options are no longer available because interest rates are zero, you can't do any more with them. Money is freely available. Do you have a view of how such a crisis would actually work out and who would come out of it not smelling of whatever? I mean, property, for instance, seems to me, I'd rather come out of feel I have an asset a worthless stock certificate.
Well, I mean, just to comment on that, I think it's always better to have actual assets that you can actually use than money in the stock market, just in terms of your own, not that one can't choose to have money in the stock market as well, but just in terms of your preservation. Having a hard asset that you actually, live in, or if, you need to move and rent out a room, or just some way of maintaining, that risk aversion is just better, and it's just real life. But in terms of, you're right, 73, 74 was different. The real difference the real difference since the financial crisis of 2008 is the actual people that were involved in running those banks and running the related treasury departments and running the central banks literally did not impose upon themselves, and there was no outside limitation on the amount of money and the level of the cost of that money they could make available to make sure there weren't those kinds of losses amongst the private banking system and some of the major companies. That's the main difference. The idea of just any sort of responsibility and any sort of check and balances over the amount of money that was created was completely out the window. If you look at the amount of quantitative easing in general in the market today, it's continuing to rise collectively amongst all these central banks, which means that the governors of these central banks over this period of time, and starting in 2008, and I blame Ben Bernanke for this, have collectively decided to continue to flush money in the system. So yes, that means that at some point, if we do have a financial crisis, and it's caused because of external factors, not because of rates rising because central banks decided to raise them, but because something else happened, something geopolitically, something between banks, some big trades go wrong, some wars happen, whatever might happen externally before there's a rate increase happens. Yes, they don't have a lot of room. But I believe in that situation, they will continue to expand their balance sheets and try to do, as they've done for the last 10 years, let's talk about the holding pattern, thing that they've done over the last 10 years, because that's the only thing they know. And the only way that changes is if the new heads or people that come into these positions get together and have a conversation about how else to help the economy or help the markets from crashing before it happens. And meanwhile, you have Draghi in the ECB. I mean, you had Jean-Claude Trichet in the beginning of the financial crisis want to keep rates up, and that didn't go over so well with the Fed. That didn't go over so well with the G7 central bank community. And then you have Mario Draghi comes in, and he just keeps rates at negative and creates money. That's the philosophy right now, and that's the difference.
But you can, just as a follow-on, these asset bubbles, which are in stock markets and in particular in property, I mean, we're getting so used to huge values for properties, which even 5 years ago would have been unthinkable. If you blow up a balloon, sometime it's going to burst.
It bursts when real people or real companies can't even pay back the debt that was accumulated cheaply. That's when, and that's when, again, the absence of raising rates. And that happening and that debt becoming more expensive because of that. It's literally the matchup between the real economy, between what people can really afford, what companies can really produce, doesn't equate to the amount of debt that's been extended.
Edmund.
Just one small point. Although our government won't hear of it, do you not feel really that perhaps we now do need some form of controlled inflation? Because inflation is any real way to get rid of debt. And at the moment, I think everybody agrees that we've got debt which individuals, corporations, indeed countries cannot possibly repay without there being inflation. And consequently, do you see any other way to resolve that problem?
If I might, there are three ways to move out of the financial crisis with a debt problem. One is to grow your way out. The second one is to write down the debt. And the third one is to inflate your way out. Now, there's a lot of people who own assets. They like the inflation. But inflation is a massive detrimental thing to happen in society because it really hits those that can't deal with inflation, those on fixed incomes, those that don't have the assets, like the children who can't get onto the property ladder. And if inflation is put forward as the answer, it leads to bigger societal problems. And I would say that ultimately, if we get another financial crisis, not that we're out of this one, then the way out would be to have debt write-downs. There has to be, across the board, how can we remove this debt from the society? But ultimately, it comes down to morals as well. There's been no accountability for the people that created this problem in the first place. It wasn't governments that created the problem. It was the excess of the banking community and the vested interests at the heart of central banking. And ultimately, that's where we need to address our problem. And that's a political thing. But unfortunately, the politicians are not up to it.
Though, talking about what politicians should be up to or have the guts to do is actually have these conversations with the central banks that are in some cases very fused and in some cases theoretically independent, but whatever, and actually talk about restructuring debt or canceling debt. And because, again, the money that was created did go somewhere. It went very specifically into a very top echelon of the private banking and sort of their customer community, and ultimately into the markets, and that had the result of inflating a lot of financial assets and other assets. It was created to go somewhere. And so another thing that could be discussed, and not so much increasing inflation, but increasing actual growth, which can lead to natural inflation, is to divert or utilize some of that money into its originally stated purposes, which are to help real companies and help real individuals and help the sort of foundation of the real economy, rather than sort of being sprinkled or helicoptered into the top. I found out traveling that the helicopter analogy was actually created by the former president of central bank in Brazil, so it wasn't even like an English term. But we use it, but helicoptered from the top, as opposed to being directed into the main economy, which was its stated purpose.
Yes, Coraline.
So growth, as has been mentioned, we're looking backwards now. I'd like to look forward. Where is the growth going to come from, in your opinion? You talk, and allied to that, which are the asset classes that we should be investing in? You mentioned land, you mentioned property, with the difficulty of the property bubble. You mentioned forestry. You haven't mentioned cryptocurrency, which I asked you about last time. But I tell you, I don't believe that's. So where's the growth going to come from? And what are the asset classes that we should be investing in?
So beyond what Steve was talking about in terms of, for example, in general, a UK type market, because it's this ongoing infiltration of money, and because the general debt to equity ratios, aside from the PE ratios, are lower here than they are, for example, in the United States. So where there are asset classes in general, you also have to look at specific lower debt to equity type of asset classes. I mean, that tends to be, for example, I mentioned China before, and it's just a way to look at where money can go and what it can produce, is they're basically using their fabricated money to invest in developing high-speed railways and the technology for that, and paying the engineers to create new sorts of methodologies, AI, those kinds of areas, because that's where sort of the world is going, and that's where a lot of the finance is going outside of what we know today to be real and preserve value in terms of assets and asset allocation. I know this, China might be a little outside of this, but for example, they had a 5-year plan, the government, that they just put out, and they said that they want their AI investment to rise to $1 trillion in the next 7 years, and right now it's at like $100 billion. So I mean, they do have a substantive increase, and what that does is it creates competition in the UK and in the US for those types of businesses, because there's a developing market throughout the world. So again, it's changing. Cryptocurrencies is a whole other thing. I mean, to me, that's not really an investment. That's a potential alternative. Currency that has a lot of issues right now in terms of regulations and everything else, maybe outside the system. But in terms of an investment, preserved investment, It'd be to follow where real money is actually going into real companies that are producing real items that people can use now or will use in the future.
Okay.
Can I come back on that?
Yes.
Because China is investing greatly, and President Xi in infrastructure and buildings, and yet there's a huge property bubble out there that's just going to implode at one point in time, possibly soon. The growth is going down as well. So China is investing in infrastructure, but it's actually, the jury's out whether what they're doing is sustainable and will produce the results that they want. So I'd love your comments on that. Secondly, artificial intelligence, robotics. That's one of the three things that keep me up at night, because if it's coming in as it is, then I think Google said it would take over 5 million jobs. Right now people are saying it's going to take over 60% of the known jobs around. Well, if that's the case, what are those people who are displaced from those 60% of jobs going to do? How are they going to earn a living so that they can buy whatever we produce through the growth that the AI is going to deliver? So we're going to be producing more goods through AI and robotics, but there aren't going to be people with real economic power to buy those goods. So back to where is the growth coming from? What are the asset classes that we should be investing in? In light of that. Sorry, Steve?
Well, I think there will be growth. I mean, the world goes on. We get up in the morning, we go to work, we do the best for ourselves and our family. I don't buy this idea that one day you're dead. So what's the point of worrying about it? Because you're concerned with your children, and you're concerned with your children's children. So it's a natural desire to get out, go to work, accumulate wealth, to try and help your immediate family and go forward. And that's the basic drive of people. So I don't see it all collapsing. I think there will be growth, but what's holding the proper growth back is the debt. And it's as Naomi's explained this evening, it's this huge amount of debt that's gone into society that we if the rates go up too high, it's just going to completely pull us all back. All the studies have been done. Rogoff and Reinhardt did massive studies to show that if debt to GDP levels gets above 80 to 90, over 100, all sorts of problems emerge, and society just cannot grow properly. And you get this wealth going in all the wrong, money going in all the wrong places. So I don't want to paint a complete picture of doom and gloom. I'd like to be positive and optimistic with the future, but I'd say proceed with caution, and therefore don't put all your money into one area. Spread the money around. Try and pick selective markets that are more attractively valued. Hold land, hold property. But I would just say there that in the 1930s and 20s in Germany, it was the middle-class property holding members of society that were hit the most badly, because those that had debt were wiped out when the assets fell in price, but B, even if they had no debt, the tenants couldn't pay the rent. So you need to make sure that you're not overly geared, overly exposed. But property, long term, is the right thing to do. Land, I particularly like forestry for the simple reason that it's a physical asset, it's a hard asset, it's a real asset that we need in society to make things. And we do not have enough timber in the UK. We import 80% of all our timber needs. So it's a good thing to diversify a little bit of money into forestry, commercial timber. In terms of holding reserves, it needs to be in the best possible areas. Now, for the long term, not everybody is in agreement, but I personally think that it makes sense to hold a small amount of your wealth in physical commodities such as gold. I'm not a gold bug. I don't think it's the only thing in the world, but I think there's evidence to suggest that for the long term, it makes sense to hold a little bit. It's the insurance against something going wrong. So there's no magical answers with anything. What we've tried to talk about today is to say there are problems out there. Don't be blinded. Be aware of what's going on. Find the knowledge that's independent, that it's unbiased, and is actually meaningful and go forward from there. But in the short term, I think markets are going to go up. And that's the message that Nomi is also suggesting. So on that note, I'd like to extend a huge thank you to Nomi for coming over and taking time out. Thank you very much. It's been highly informative and interesting, and I hope that if you've enjoyed it half as much as I have, then I'm sure you've had a good time.